Welcome back to our ESCoE COVID-19 webinars focusing on economic measurement during the epidemic. And we've had a break over the summer and also in September where we had our annual conference. And I'll take this opportunity to encourage you to have a look online at some of the discussion that took place at our measurement conference, much of which concerned the issues we are covering in this series. Details are available on the ESCoE website. And today, we're delighted to have with us Professor Gregory Thwaites from the University of Nottingham, and he will be talking about some of the lessons for productivity coming from the Decision Maker Panel Survey. And Greg will present for 40 to 45 minutes. We will then have some time for questions after his talk. If you have a question, then please, if you could use the Q&A facility at the bottom of your screen to type. And if you're invited to speak, you'll need to unmute your microphone and please mention your name and affiliation. Please also note that this seminar is being recorded. Greg, the floor is yours.
Can you, okay, can you hear me and see everything okay?
Yes, all good.
Okay, all right, well, I'll get started then. So thank you very much indeed for the kind invitation and for the introduction. It's a pleasure to be here. And I'm going to talk to you today for about 45 minutes about the impact of COVID on productivity. This is, of course, very preliminary work in progress, so I'm relying on you to help me improve this work with your questions and comments. This work is joint with Nick Bloom at Stanford, my erstwhile colleagues Phil Bunn and Pavel Smeartanka at the Bank of England, and my current colleague Paul Mizzen at Nottingham University. So this topic is, of course, one that needs no introduction. The impact that COVID has had on GDP, not just among the OECD, but indeed in the world, has been larger, much larger than the financial crisis. And it's been an extraordinarily deep and synchronized shock. So we're all interested in studying what the impact is going to be on various aspects. And in particular, I'm going to show you here the impact on GDP at a monthly level in the UK and the US, and on hours worked. So what you can see here is that, of course, there was a very large fall in GDP in the early part of the year, and then there's been a partial recovery, and this was much deeper in the UK, at least to begin with, than in the USA. You also see, according to the ONS data, a very large fall in hours worked. But what we're starting to see now is both of these things recover. And of course, the ratio of GDP to hours worked is labor productivity. And what I'm going to be talking to you about today is what we've seen COVID do to labor productivity, why that is, and to breaking it down into its different components, and then also to provide some kind of a forecast for what's going to happen over subsequent quarters. So what do we find? What do we do and what do we find here? So we're going to take a very large scale monthly survey of 3,000 UK firms that I've been working on with my co-authors for 4 years now, and I'm going to talk to you about in detail in a minute. And we're also going to show you some evidence from a sister survey that's a bit smaller of US firms. And we're going to combine that with accounts data to estimate the impact of COVID-19 on productivity at the firm level and at the economy-wide level. What do we find? We're going to find that total factor productivity is going to be depressed by about 2% by the second quarter of next year, and that this is going to be comprised of two offsetting components. There's going to be like a within firms productivity decrease of about 3% in TFP, driven largely by firms' higher costs, which we think are largely intermediate costs. And I'm going to give you more detail on that in a minute. So the typical firm, employment weighted, is going to see lower productivity of about 3%. On the other hand, there's going to be a boost, in fact, to productivity coming from the fact that productivity will, rather output and employment will shrink the most in the least productive industries, and within those, the least productive firms. So less of the output and less of the resources of the economy are going to be accounted for by less productive firms, and that's going to boost the average level of productivity, we think. In the long run, there's probably also going to be additional negative impacts from lower research and development and less managerial time spent on other things. And we think this is ominous for long run growth because it comes at a time when productivity growth around the world, especially in the UK, has been very weak. So we think it's going to turn negative for a short period of time. And let me give you some of our key results for the UK in one figure. So this is the impact that COVID is going to have on different measures of productivity. So in terms of labour productivity per job, we saw a very, very large, unprecedentedly large fall in the middle of this year. And that's because employment in terms of jobs did not fall very much. Whereas output did. We're expecting output to continue to recover and labour productivity per job to end up a little bit lower than it was before this all started. Labour productivity per hour, we actually think was boosted above trend in the middle part of this year. And that's because hours worked fell by most in those industries where productivity was lowest to begin with, and this offsets the negative effect on the productivity of any given worker. TFP has already been depressed, and that's because capital inputs have fallen by less than labour inputs per hour. For many economists, this blue line TFP will be the most important, the single best summary measure of productivity in the economy. We expect that to trough around slightly more than 5% below the counterfactual level around now, and then to recover to something more like 2-ish% below trend by the middle of next year. So these are our key results. And what I'm going to do next is show you like how we measure this and and then how we go from the measurements to these figures. So yeah, let me talk a bit about measurement. I know this is a group of people who are very interested in and knowledgeable about measurement. I'm going to tell you about the survey data that we use to produce these estimates. So we use something called the Decision Maker Panel, and this was started, I think, in August of 2006 after the Brexit referendum. We wanted to measure the impact of Brexit on the economy. And so we very quickly established a survey in the summer of 2016, and we set up a call center, you can see here, and a recruitment team that's done amazing work over the last 4 years to phone firms to get them to join the panel. And then once they've agreed to join, we send them a monthly online survey, which we try and keep as short as possible. We do things like we send them mugs to say thank you and to keep them in, and like little USB chargers here, because it's of course really important to keep people in the panel for as long as possible, so that we have a panel element in the survey. We're very happy with the results that we've seen over the past 4 years. As it's grown, it's gone from strength to strength, and we now cover something like 14% of private sector employment in the UK, which isn't bad. We thank some people who might be listening, including the bank, the ESRC Nottingham and Stanford, for generous funding, and you can see here that the list of people that helped us along the way is very large. So who are the respondents to this surveys? Mostly they are CEOs or CFOs. So we tend to get, we think, relatively high quality responses from the top or near the top of our firms. And you can see here, like, I think something like 3/4 of the respondents are CFOs or finance directors. So we asked them all sorts of questions. We would ask, for example, how much revenue did you make in the last quarter? And they type a number in like this. And then we also asked them about their subjective expectations for the future. And in particular, in this case, what we think the probability distribution would be over different scenarios. So we're able to construct subjective distributions for the future. And these are objects which are extremely interesting in and of themselves. And I'm going to show you that the responses they give are reasonably high in quality. But before I do that, let me show you that we think the DMP is reasonably representative of the UK economy by sector. You can see here that the share of respondents by sector matches reasonably well the percentage of employment according to Bayes by sector. Not perfect, but not bad. And probably more importantly, when we ask firms what the level of employment is in the firm, or what the level of sales is in the firm, and we compare that to the official accounts data, which is the company's house data in Bureau van Dijk or Amadeus or Orbis, different people will call it, we see that the two stack up really quite closely together. And when we look at the distribution of employees by firm in our sample, according to Bureau van Dijk or according to the DMP, we get a pretty good matchup. Not a perfect one, but a pretty good one. And another thing is that it turns out that firms are pretty good at forecasting their own sales. So you wouldn't expect, so for example, what I'm showing you here is this is the expectation that firms have of their sales growth over the next 12 months. And then zooming forward a year, because we've got the panel component and data, we're able to look at the actual realization. So you wouldn't expect like a one-to-one correspondence, everything to stack up against the 45-degree line, because firms aren't able to forecast their own future perfectly. But they are able to forecast it reasonably well, as you can see here. Particularly with employment, they do a good job of measuring, of forecasting their own futures. Price, investments rather more dispersed. But the reason I show you this is not only because it's interesting to see that firms are doing are kind of giving us reasonable numbers, but that they are able to forecast their own outturns reasonably well. And that's important, because a lot of what I'm going to show you coming up is about the forecast that they give us. And this information is used for all sorts of things now. There's a picture slightly out of date, one of the former governor of the Bank of England, and the bank, amongst others, the Treasury, Bayes, rely increasingly heavily on this as a key source of close to real-time information about what's happening in the economy. And I think what's been extremely valuable has been the ability to change the composition of the questions that we ask as the salient issues change. So to begin with, we were asking lots about Brexit, and of course that's still a very live issue, but right now COVID is at the forefront of everybody's mind. It's reasonable to ask whether COVID has had a detrimental effect on the response rate in the survey. You can see here the blue bars show the impact, the number of responses per month to the survey, and you can see, the survey membership has grown substantially over the history of the survey, and like I said, we're now at roughly 3,000 firms. And then the response rate of active panel members, where we define an active panel member as somebody who's responded at least once over the past year, has been reasonably flat. Now, what you'll see is that there was a big tick down in March because all hell was breaking loose in March, but that there was a reasonably good recovery, and we're now, I think, back to something like where we were in the middle of last year. Now, you know, we're always trying to boost the response rate and the number of people in the panel, and we think that we're doing a reasonably good job of not having COVID affect the response rate to the survey. And let me show you also that we think that the response rate has not, or rather the composition of the firms responding to the survey has not been adversely affected by the pandemic. So here I'm showing you the coefficients on a simple linear probability model, which is the probability that a firm responds to the survey, given that they're in the sampling frame where you get coded a 1 if you respond and a 0 if you don't. That doesn't seem to be correlated with by industry, the impact of COVID on sales. It's true that larger firms seem to be more likely to respond, but this was true, as you can see, because I'm using a pre-COVID, including a pre-COVID time period in the sample here. This was always true. This was true before the sample. And what I've done here is interacted these coefficients, be they industry dummies or industry impact, or the level of labor productivity. I've interacted those with the with the COVID period, and you can see here that those interaction dummies are statistically insignificant. So we don't see any evidence or statistically significant evidence that response bias, to the extent that it existed in the survey before COVID, has changed at all. Hopefully I've whetted your appetite somewhat to know more about this survey. There's plenty more information on our website, which I encourage you all to go and visit. And you can find out about the questionnaires that we've asked in the past. You can download data and slides, and then you can also fill in a form to ask to use our data for your own research. And it's, you know, something that we would very much like to see more of. People have used, like I said, our research for lots of policy analysis. We're keen for that to continue, and also for researchers to use it to answer questions that they're interested in. Okay, I know that I'm supposed to wait till the end for questions, but I'm just going to pause for a minute now because I've rattled off an awful lot of information before I go on to what the findings are from this survey, just to see whether there were any questions that couldn't wait until later about the nature of the survey itself, if that's all right, Rebecca.
Yes, of course.
So how are we going to do this? So there's questions about TFP and capital utilization, which I'll come to in a minute. And there's, I think, a question from Jonathan Haskell about who's he. I think he might have been referring to the mugshot of Mark Carney, but then maybe that's right. So any more questions at this stage, or shall I plow on, Rebecca?
I think here we have a quick question.
From Raymond. How are you doing, Raymond?
Would you like to, should we take that question now, or do you want?
Yeah, why not? Let's do a quick one. Yeah.
Okay, so Raymond.
Hi, Greg.
Hello.
Really great paper, timely. I love this DMP data. Quick question: when you showed hours in the previous table, how are respondents responding on furlough workers? Are we going to come to that later?
Yeah, we'll come to that, but I think basically if you were on furlough at a time when the furlough was the inflexible furlough and it was all or nothing, then your hours are 0.
Okay, cool.
I think that's right, but yeah, I'll triple check that and come back to you if I'm wrong, but I'm pretty sure that's right.
All right, thanks, Greg.
Okay, all right, so I'll keep going then. So we're now on to the impact of COVID-19 on inputs and outputs. So yeah, here you can see some of the questions that we asked our panel members. So we asked them a question like, relative to what would otherwise have happened, what is your best estimate for the impact of the spread of coronavirus on the sales of your business in each of the following periods? So we asked them what the impact of COVID would be on their sales. And then they might say higher, no impact, or lower. And then we asked them to put numbers on this. So if, and you can see what we did here was this kind of two-stage approach, so that there was less chance of people getting confused by positive and negative percentage numbers. So if they said sales were low, we would say, right, okay, by how much lower? And they might say 20% lower in the third quarter of this year, and then 10% and 0% and 0%. So those are the kinds of questions that we asked. And then what were the results that we got from that? Well, you can see here, for example, the impact of COVID on sales by industry in 2020 Q2. And unsurprisingly, it's these accommodation and food and recreational services industries, the most customer facing ones, if you like, that firms said would be hit the hardest. Now, we've of course seen this in other data that's available from official sources, but this again I think is really important validation for what's coming next. Over the course of the summer or the middle of the year, since we've first been asking these questions, you can see that firms have become slightly less pessimistic. So, by September, they're basically reporting an outturn rather than an expectation that they initially were back in May. And to the extent that this red line is now above the other lines, it shows that they've become less pessimistic over time. It's going to be really interesting to see what happens when they answer in the coming month, because of course the situation with the pandemic and the restrictions has become more serious. So it's going to be interesting for us to see whether there's some kind of renewed pessimism amongst our respondents. Let me show you, for example, that there's a gigantic rise in sales uncertainty. So, I was talking about the first moment. Now I'm talking about uncertainty about the growth rate of sales over the next 4 quarters. This is not, by the way, asking them about uncertainty related to COVID. This is just asking them about the different scenarios for uncertainty. Then we construct the probability distribution on the basis of that, and then take the standard deviation of that. You can see that the pattern in the US is very similar indeed. And that this is kind of mostly in the form of the left tail of the distribution moving out to the left. So you can see here that the lower percentiles of realizations are the ones that have been affected the most. I mean, there are some firms that seem to be, and again, this is probably unsurprising, the very top of the distribution may even have gone up slightly because of COVID. I mean, there are some firms that are doing better than they would have done because of the situation that we're in. So that's a headline of some of the impacts that we've seen. Now, this is probably one of the most informative charts that I've got to show you today. And what it shows is the average response, employment weighted across firms, of to the questions that we ask them about the impact of COVID-19 on their inputs and their outputs. So let's take, for example, this sales question. We've said, what's the effect of COVID going to be on your sales in each of these quarters? And then we've taken a weighted version of that, and the trough was at about 25% of sales, and by the middle of next year, we're expecting that impact to be something slightly more like 5%, about 5%. So that's sales. The sales is expected to recover. Hours worked, so yeah, so this is the hours worked question. So we've said, like, by how many hours do you think are going to be worked at your firm? And that's obviously plummeted a very great deal, by more than sales, in fact. And then this is employment in heads. Employment in heads is going to converge towards hours worked by the end of the year. Investment is also going to take a colossal hit, it seems. And what we've done here is we've cumulated the impact of those lower flows of investment onto the capital stock. And what we find is the capital stock isn't going to change very much, but that's because, you know, most of the capital stock that's there is still going to be there. It takes a long time to depreciate. This question on unit costs is going to be doing a lot of the work, where we ask firms, like, essentially, what's going to be the impact of COVID on their costs. Let me see if I can find the exact. Yeah, this is the question. Relative to what would otherwise have happened, what is your best estimate for the impact of measures to contain coronavirus on the average unit costs of your business in each of the following periods? And you can see here that this unit cost measure is going to rise, and we interpret this as having to put more people on the door of a shop, or having to provide PPE like perspex screens and hand washing facilities, and all of these things that will come out of value added and therefore tend to reduce productivity. So how are we going to turn that into a productivity measure for the economy as a whole? I'm going to focus, like I said, on two measures here. One is labor productivity. So I've got Y is final sales minus M is intermediate inputs divided by prices. So this is in real terms. And intermediate inputs is the unit cost of an input times output itself. And then I've got the analogous version of this, where instead of taking this as a ratio to labor inputs, where labor inputs I've shown you both heads and hours, I can also take it as a ratio to a weighted average of labor and capital inputs, out of which will pop TFP. And you can see here, when I take the total derivative of this, I'm getting the change in labor productivity is equal to the change in output minus some number times the change in unit costs minus change in prices and the change in labor inputs. And again, for TFP, it looks just the same, but instead of just subtracting the growth rate of labor inputs, I'm subtracting the growth rate of a weighted average of the growth rate of labor inputs and capital inputs. Let me just fish out a glass of water. 1 second. Okay, so and then what I need to do is I need to go from this firm level information to an economy-wide estimate. How am I going to do that? I'm going to use like a fairly standard productivity growth decomposition. This is the one that Baily back in 1992 popularized, where what we've got here is the overall change in the in this case GVA per head, but it applies to any productivity measure. So what we've got is we've got this within firm effect. So taking the employment shares, the average employment shares of the firms in the economy, I'm going to say what's the employment weighted average change in productivity within firms. So this is like, if a typical firm becomes less productive, that's going to push down on productivity. Then I've got this other second term, which is probably less obvious to people who haven't thought about this as much. But what we've got here is we've got reallocation of employment shares between surviving firms. And this is this between firm effect here. So amongst the set of surviving firms, we're going to have an effect here, which is basically, do we see the least productive or more productive firms shrinking the most? So if the change in the change in employment is uncorrelated with the productivity level, then this term would be approximately 0. But what I'm going to show you, and as I've highlighted already, what I'm going to show you is that it's the least productive firms who are going to shrink the most, and so this is going to boost productivity. There's a couple of things which you might think of as extreme forms of reallocation. So the first one here is about entry. So when firms enter into the population of firms, they will affect the productivity level of the average, depending on whether they are above or below average productivity themselves. So what I'm going to show you is that firms which enter the population are typically more, they're typically less productive than firms which are already in the population. So entry, in the short run at least, tends to lower productivity. And if you get less entry, then it will lower productivity less, and productivity will be higher. Same goes for exit. Exiting firms tend to be less productive than the average, which is why they exit, right? So if we see more exit, then other things equal, the contribution from exit will also be more positive. Last point here. This delta is not a delta with respect to time, but rather a delta with respect to COVID. So what I'm interested in here is the change in the membership of these sets of entering and exit firms, exiting firms because of COVID. Right, so that's the, I've shown you now the framework. So let's run the numbers through that framework. So this is, first of all, the impact of labor productivity, the impact of COVID on labor productivity per hour and TFP within firms. And here what I've done is I've just applied the formulae that I described earlier. So because labor input's going to fall a lot, you're going to see a positive contribution at the firm level from lower labor input, and then you're going to see a negative contribution from sales, and also a negative contribution from costs. Sales are going to fall, and costs per unit of sales are going to increase, and these things net out as a fall in labor productivity at the within firm level. And then the same goes for TFP qualitatively, but the labor input component receives a smaller weight, so it's like a 2/3 weight rather than a weight of 1, and the capital input, if you squint, you can see there's a tiny wee capital input component here, but it's almost nothing, because capital input doesn't change very much, because capital doesn't change very much, because even when investment plummets, like firms are saying it's going to or already has, it takes a long time for that to accumulate into an appreciably lower capital stock. So whereas the sales bars and the costs bars have basically the same impact, I think, and therefore the impact on TFP is going to be more negative than on labor productivity per hour. There's a couple of things that I wanted to say which we're just building into the survey now, but I wanted to give you a sneak preview of. The first one is we've actually asked firms what the impact is going to be on R&D. So we've asked them, what's the impact of COVID on your research and development spending? Firms have said that the impact is going to be negative. And so we're pushing down by 10 to 15% on R&D as a result. Now, what you'll have seen is that the thing wasn't doing superbly well anyway, and it's going to be doing rather worse now. And then I've got a cheeky little Brexit chart in here. What we did in a different paper was looked at the impact of Brexit on productivity, and we found that the impact was going to be negative, and that one of the reasons it was going to be negative is that managers of UK firms are spending an inordinate amount of time thinking about Brexit rather than thinking about other things that could make their firms more productive. And if you think that managers, generally speaking, their time was well spent making their firms more efficient, then if they're diverting hours of their time, like 5-10% of their time in some cases, these very senior, highly paid people, to planning on Brexit rather than planning on their businesses, then that's going to have a negative impact. We're just asking now in the thing that's going to be in the field over the coming months, we're going to ask them the time that people are spending on COVID planning rather than on other things like Brexit, but also just the general order of business. And depending on the numbers that come out of that, we'll see a further decline in productivity at the firm level. So the numbers that we have, of course, are provisional and will probably become more negative when we build in this R&D effect and the time spent, the managerial time effect. So that was the within firm effect. Now let me talk about the between firm effect. So what I've done here is drawn a bin scatter of labour productivity at the firm level. And what I've done is I've said, okay, is it true? And I've taken that from official accounts data. And I've said, is it the case that the least productive firms are the ones whose hours worked shrank the most in 2020 Q2 and are expected to shrink the most in 2021 Q2? Answer, yes. So because of this, we're going to see higher productivity firms shrink less, and therefore the average productivity level of the economy to increase. This chart, I think, is quite nice, and it shows that the effect was extremely powerful in the middle part of this year, but it's still going to be there, firms think, by the middle of next year. And so there's going to be a continued boost from the between firms effect, although obviously a much smaller one as this line gets shallower. And this is partly because higher productivity firms, industries shrunk less. So apparently estate agents are extremely productive and their business fell quite a bit, but it's the recreational services and accommodation and food sectors, these customer facing ones, which I showed you, are anticipating a very large hit. And also, as you can see here, continue to anticipate a large hit into the second quarter of next year. These are the ones that are least productive in terms of GVA per jobs. So it's partly an industry story, but it's also a within industry between firm story here. So what I've done here is I've shown the impact of COVID on, this is a regression of the impact of COVID on hours worked as a function of labor productivity per job. And you can see here that the coefficient is expected to shrink a great deal between Q2 of this year and Q2 of next year. Like I said, the line's going to flatten, but, and this is the key point from this chart, the coefficient remains negative and significant, at least in terms of labor productivity per job. It's not quite significant here, but when we add industry dummies, so I'm saying even within industries, so it's not just a between industry effect, it's a within industry between firms effect here. So even controlling for the industry level of productivity, the least productive firms in the industry are the ones that said they shrank the most in 2020 Q2. We don't see a statistically, the T-stat here is about 1. So we don't see a statistically significant effect on labour productivity. We see a borderline significant effect here in 2021 Q2. So the within industry across firm effect is there now and is shrinking, but may still be present in 6 to 9 months' time. So you can see here these within industry and between industry effects that I've just decomposed for you. Like I said, they're very positive for productivity, and that positive contribution is expected to wane over the coming few quarters, as this line that I showed you flattened. Right, and then so what I've done is I've shown you the between firm effects, which are positive for TFP, and then the within firm effects, which are negative for TFP. Let me talk a little bit about entry and exit now. So this is the birth rate of firms with 10 employees or more, which is the sampling frame for our research, and this is the death rate. And then what we've done now, these things haven't moved very much so far, and that's for a number of reasons. One is that things like the furlough scheme and the business support schemes have prevented firms from going bust that maybe otherwise would have. There's also just, I think, administrative delays involved in closing firms. So it's reasonable to expect that firm deaths will pick up over coming months, and also that firm births will fall. These are, I would say, scenarios rather than hard forecasts from us. But taking these scenarios as they are, what will be the impact on labour productivity per job? In this case, what we've got is, I can tell you that firms which typically enter with about 80% of average productivity. So more entry means lower productivity in the short run, because we're getting more new firms in the population, dragging the average productivity down. Firms who exit, what we're assuming here is that there will be more kind of positive selection of firms exiting the population. So we're going to say that firms which exit are going to have much lower, they're going to be further below average productivity as a result of COVID. And that's essentially an extension of what we've seen amongst surviving firms. And you can think of exit as like an extreme form of shrinkage. And then, so we think that there's going to be maybe an extra 1% on employment. It's going to have an effect of 1%. Let's say, sorry, about 1% of employment will be affected by lower entry, and that will boost aggregate labour productivity by about 0.2%. About 1% will be taken off. There'll be about 1% extra of employment exiting the population as a result of higher firm exits, and that will boost labour productivity by about 0.4%. And combining these two things together, we get maybe a plus 0.6% effect on aggregate labour productivity. Putting all of this together, so what we can see is that there's going to be a roughly 1%. There's going to be something like, I'm going to focus on TFP, and you can read these numbers at your leisure. There's going to be about 3% on average off productivity at the firm level within firms. There's going to be a boost of 0.7% on the productivity of firms, continuing firms, because of the change in the mix. And so this is qualitatively the same, but much smaller. And then there's going to be a boost from this effect on entry and exit that we saw. And so we're expecting that by the middle of next year, productivity will be about, total factor productivity about 2.3% below average, below the counterfactual level. So let me summarize. Roughly speaking, like again, this is all very much work in progress, but our provisional results suggest that the overall impact will be about -2% on TFP because of this offsetting impact within and between firms effects. That this will compound the already slowing rates of productivity growth in the OECD. And this is before we've built in these extra effects from lower research and development, and also from managerial time. And in the case of the United Kingdom, what we expect to be quite a seriously negative effect from Brexit. And that we therefore face a period of slowing growth for the next few years. Now, I couldn't end this talk without, to you people, without talking to you about some of the measurement issues that I see coming up in the data. So what we've tried to do is try to talk about true or underlying TFP, and there's going to be a gap between that and what statistical authorities will measure. And this, of course, is not a criticism of the people whose job it is to measure the economy, but rather just something that is inherent in the way that economic statistics are collected and processed. So we think it's going to be harder to measure prices because of the range of goods and services being restricted. There's also rationing in some markets, and it's like a debating point whether this would whether this should be thought of as a price change. We think that capital utilization will be strongly negative, and so there may be an overstatement of capital inputs unless there's a correct adjustment for capital utilization. On the other hand, there's this effect from working from home. So we think that workers working from home employ capital, such as, so the laptop that I'm talking to you from now is my home laptop, but I'm producing market sector goods with it. And so the capital that I'm using my own capital to produce somebody else's value added. So we're under recording capital inputs. And then also the intermediate, so the electricity that's powering this laptop as I'm talking to you is contributing to the value added of, I guess, Nottingham University, but not being recorded as such. And therefore we're under recording some inputs. We're also, we may be understated in labour hours by working from home if home-based employees work longer per day. I have at times had to look after my kids. I've been amazed that they haven't been interrupted so far today. One of my kids being at home. So on the other hand, labour hours may be overstated by people like me having, and I'm sure some of you, having to carry out childcare while working. And there's an issue about labour utilisation, which could tend to push down on measured total factor productivity. And then there's also an issue about survey response rates, which, a bit like price measurement, will just introduce noise. It's difficult for me to say what direction the bias is going to be. These issues have been covered, many of them have been covered elsewhere in an excellent series of articles by the ONS, which I commend to you all if you haven't already seen them. So I'm just going to put my summary slide back up and then pause for breath and invite you all to ask questions. Rebecca, do you want to boss these for me?
Sure. No, thanks very much for your excellent talk. So I think we're going to take a question from Jonathan Haskell first, and then Kevin Fox. Yeah, it's really interesting to see your conclusions about the reallocation of resources between firms working to improve productivity in the current circumstances. I think, one of the issues that's sometimes raised is the difficult trade-off deciding, between supporting firms and workers through this crisis and then also deciding when to let structural change take place. So I wondered if you might want to say something about that. And you've highlighted some of the upcoming questions in waves of the survey, DMP ahead. I was also wondering whether you had any other highlights for us.
Yeah, so on structural changes, this is really tricky, right? Because you don't want to arrest the normal process of creative destruction that provides at least part of the productivity growth in a normal period of time. And the furlough scheme, by subsidizing employment relationships, and you basically only get the money if your firm remains in business and you remain employed by the firm, it's going to be preventing the dissolution of some matches that should have happened or would have happened in the absence of COVID. And I think the longer that time goes on, the worse, the bigger the damage that's going to have. Like, on the other hand, it's doing a really important job in supporting the incomes of workers and of so providing some form of social insurance in a country like the UK, where our replacement rates are very low. So there's a very difficult balance to strike. I think one thing that should be seriously considered is some kind of lump sum benefit that isn't contingent upon an ongoing employment relationship or the firm you're working with being like a going concern. I mean, that will also have problems, but maybe the balance between the arguments in favor of something like that versus the furlough scheme that we have now will shift as time passes. On your point about questions we're going to add, so I've already talked about the managerial time questions, so those would be ones that we're going to have to continue to ask. Of course, we're going to continue to ask about Brexit, particularly now as some kind of resolution is going to be reached one way or another over the next few weeks. And I'm very open to suggestions either now or over email about things that we could ask. That's one of the really nice advantages of having this survey is that we can, subject to overall constraints of length, we can ask whatever we like.
Thanks very much. So emails to Greg. Jonathan Haskell, would you like to ask a question?
Oh, thank you very much, Rebecca. It's Jonathan speaking. I don't know if everybody can hear me.
Yeah.
Oh, brilliant. Thanks so much, Greg. Really enjoyed the seminar. Incredibly interesting and very clear. It's really a question of interpretation. If, for example, a retailing firm has to install, let us say, a plastic screen, I absolutely accept that that's a change in the sort of productive arrangements for that firm. But I would think of that as being an increase in the capital stock that the firm has to install, a peculiar piece of capital stock, but nonetheless an increase in the capital stock, rather than a change in its TFP. So, as I say, I don't dispute that you're documenting something very interesting about the change in the productive arrangements in the firm. But I just wonder whether it's capable of a different interpretation. Thanks again.
Thank you very much, Jonathan. I mean, I'll have to reflect at greater depth about that question, but could we think of it as like a fall in capital productivity? So, I mean, if ultimately the value added of the firm doesn't increase, but the amount of capital that you need to produce that value added does increase, does that not show up somewhere in productivity?
Yeah, so I mean, in a way, the firm is being, as it were, taxed because it's got to install a piece of capital stock which is useful in current times, but would otherwise be not very useful. So I mean, I think that's the right interpretation. Quite whether that's a change in TFP, I'm not quite sure. So I think we're quibbling about interpretation here. Okay. But it's still so yeah, we're just quibbling about interpretation here, but it's still extremely valuable, to gather the information about whether this is big or small across the different industries.
Well, I'd certainly put that point in when we write the results, and we're just writing the paper up now. Thank you very much, Jonathan.
Thank you.
Thank you. Can we have a question from Kevin Fox and then George Duran, please?
Thanks, Rebecca, and thanks, Gregory, for that very interesting presentation. You know, I'm a measurement guy, and I worry about how things are measured before they're interpreted. And I noticed that in your Cobb-Douglas aggregator for your inputs of capital and labor, you're just assuming these constant coefficients, beta and alpha, 2/3 and 1/3. And so you're assuming they're constant, you're assuming the values. I just wonder why you decided 2/3, 1/3. I know it's pretty standard, but it would have been good to have some idea about whether that decision was based on actual data. And holding those coefficients constant over time is problematic in the best of times. It's probably even more problematic during a crisis. So I wonder if you have any thoughts, comments on that.
So I think what we should do is we should do some, thank you very much indeed, Kevin. I think that's a really important point. I think what we should do is some sensitivity analysis according to like reasonable variations in that assumption. I would love to know from you, perhaps if you send me an email, how we would do the time varying coefficients, what we would do. So I think what we can do quite easily is use, for example, industry level averages for the capital and labor exponents. If you've got like suggestions for how we do the sensitivity analysis most appropriately, then please just send them over, because of course we want to get this right.
Yeah, thanks. I would just note that what you're doing here is quite different from what a National Statistical Office would do in calculating productivity. So it's a bit difficult to go from what you've got to what perhaps the ONS might calculate.
Okay.
Thank you.
Rebecca, is Jorge next?
Thank you, Kevin. Yes, yeah, George Duran, please.
Yes, just a very short question. I was wondering if in your survey you gather any information about the very long run expectations of these managers. I'm particularly interested in knowing if these people if there is any differences per sector on the perspective of eventually going back to normal, or if there are sectors that expect a permanent effect of this crisis.
Thank you, Jorge. That's excellent. And in fact, that reminds me, this is one thing that we're going to add very shortly. We're going to ask about like a medium-term impact. So you've noted absolutely right. We're asking mostly about the next 3, 4, 5 quarters. What we've got coming up is we're going to ask a question about like the medium-term impact. So hopefully the next time I give this talk, I'll have an answer for you about that, because it's a great point. And it reminds me that I forgot to add that to my answer to Rebecca's question about next questions. Thank you.
Thank you very much.
Okay, can we have a question from Joe Grice and then from Margaret McAvoy, please?
Thank you very much. I thought this was fascinating material, and it all seems very plausible too. The question I had really was one about emphasis. The estimated effect you have, 2%, 2 to 3%, is significant, but still quite small in relation to the existing UK productivity gap, which on many calculations is now well in excess of 20%.
Yeah.
So isn't the most worrying part of this your findings with regard to the uncertainty and the effects on business investment? It seems to me that is going to lead to, we've seen very depressed business investment in the last 10 years or so now, and we're going to see, by all accounts, that continuing for some little while. So when you tell the story, you mentioned the effect on business investment and on R&D, but I just wonder whether that isn't actually going to be the main course rather than kind of the add-on on top of the analysis you presented today.
Thanks, Joe. Yeah, I guess that's a really important point. I think the investment effects will take time to accumulate, but perhaps relating to Jorge's question, this is, obviously the medium run is going to be you know, when we're past this pandemic, it's a really interesting question for us. And if investment has been depressed for a long time, then it will eventually accumulate, particularly if you think that investment, you know, the exponent one way or another is higher than you think on investment and capital because it embodies technical change or something. But yeah, we'll build that into the next draft. Thank you, Joe.
Thank you. Then if we could have a question from Margaret McAvoy and then Francis Ruane, please.
Can you hear me?
Yes, Margaret.
Yes, good. Thanks very much, Gregory. Really enjoyed the presentation and look forward to receiving the slides. I'm a former chief economist, by the way, from Office of Manpower Economics, just to identify myself. Now, there seems to be some evidence from what you've put forward of Schumpeterian creative destruction going on already, I think, which you've identified. However, because of the furlough scheme, there seems to be, I think, further to go on that when the scheme ends. And I know you've sort of touched on it a bit, but is there anything to be gained really from looking at what happened in earlier crises like the financial crisis and perhaps even others in the 1980s?
Thanks, Margaret. Yes, I think there is a lot to be gained from that. What we can do is use past experience to calibrate our expectations about the future. In terms of the survey, as opposed to the interpretation of the survey and the broader building of the picture, it's of course very tricky for us to ask our respondents, like, if they think they're going to go bust. We can't ask anyone who isn't yet a firm whether they're going to become a firm, and then once firms already have gone bust, there's no one there to ask. So I agree it's a really important issue, and I think calibrating over the past is probably the best thing that we can do because of, you know, these issues about getting at it in the survey itself. But thanks, Margaret.
Francis.
Hi, thank you. That was a great presentation. You had a tantalizing table in there which showed US on one side and UK on the other, and you didn't have figures in yet for the US. I was just in the context of the discussion just now. You might expect that the reallocations would be faster in the States given their situation with regard to ease of entry and exit and faster setting up. So I'm just wondering, is there any indication of differences between the US and the UK in terms of productivity decomposition? And I'd just like to mention at the same time that when people work from home at the moment, I agree with you about there's additional costs not being carried by the firm, but meanwhile the firm has a whole load of equipment that's not being used by the workers who are at home. So there's a kind of a mixed effect going on there. Thank you.
Thanks, Francis. Again, like, really interesting points. I agree the US stuff is tantalizing. I promise to make it public as soon as I have it. We have an issue about getting the questions asked in the US and processing the answers. On reallocations, like what I think I've been told is that business formation has been very rapid over the summer in the US. I think that's correct. Someone can correct me if it's wrong. And I wonder whether some of that's got to do with the fact that the labour market operates differently, and then also that the labour market support, to my understanding, has been less about preserving existing matches between workers and firms.
Thanks for those questions and answers. So I think we're going to go to a couple of questions from Josh Martin and Richard Harris. We're running slightly over time, but let's allow for that.
Thanks, Rebecca. Just to come in on a couple of questions here around business formation, business closures, that sort of thing. We've just started publishing at the ONS some data on exactly that on a quarterly basis using data from the IDBR, the Interdepartmental Business Register. That doesn't show a pickup in business deaths just yet.
Yeah.
There are some statistical and legal lags, which mean that we might not see that effect for some time, although one might expect it to come eventually. We saw a reduction in business births in the second quarter, but actually a big increase in the third quarter. And you're right, Greg, that in the US, they've also seen a big increase in business births. So I just wanted to sort of flag up that data to you and suggest it might be worth possibly dialing back on your assumptions there, which seem to be at least not yet rooted in fact.
Yeah, I think that came out a couple of weeks ago, didn't it, Josh? And it's we haven't updated on the basis of that just yet, and it's it's a wonderful resource that you've published. So thank you. Is it Richard Harris next, Rebecca?
Yeah, sure. Sorry, yeah. I think what I'm wanting to put forward is pretty much being covered to some extent by other questions, but it's just that when you look at productivity decomposition analysis, most all the literature shows that 50-odd%, and Rebecca's done this with her work using the ABI, about 50-odd% of productivity growth is due to Schumpeterian churn, and yet that's not featuring in what you've got. And I suspect to some extent it's about the panel that you're using, because you've already said yourself, you can't survey people, firms that haven't started yet, and you clearly can't survey them when they've gone bust because they're not there anymore. So in some sense, you're picking up a more stable sample, aren't you? So I suspect you're underestimating the impact of churn on productivity decomposition, and as we go forward in time, I suspect that will become larger and larger.
Thanks, Richard. I'll have to go back and double check what we've done. I think what we tried to, this is what we tried to get at with our assumptions about increased deaths and reduced births. And we've obviously had to make a difficult assumption about whether those firms in those populations are more or less productive than average. And I guess it relates very much to the point that Josh Martin just made just before you about having seen a reduction in births in Q2 and a big increase in Q3, and no pickup just yet in deaths. So for as long as deaths don't pick up a lot, or deaths look like previous deaths, we should expect the contribution to remain the same. But either of those things could change at any point. And Josh has rightly pointed us to his work where he shows that there's been a big increase in births in Q3. So it's going to be interesting to see whether that part of the churn will have a bigger effect than before.
Okay, thanks very much. I think there's a few more questions, but I think we're going to have to close, and we can save them and pass on to you, Greg. So thanks very much for sharing this new analysis. It's obviously of a lot of interest, and thanks for all the questions that we've received. Our next webinar will take place in a week, where we'll hear from Nick Bate and Alistair Farrell about the Bank of England's use of faster indicators of economic activity since the COVID outbreak. So thanks again, Greg.